and then we can get started. Alrighty, so a lot has happened since the last time around. We've talked about a lot since May. During our last conversation, we're looking at the updated COVID information, the updated expectations for the economy. Where are the pockets of opportunity? Where are the pockets of weakness? What can you do as a business leader to come out on top against your competitors, to kind of focus on the areas of opportunity? That's what I'm here today to do, is to make sure that this economic information that I'm passing on is applicable day in and day out in your everyday, even personal lives, but also the business lives on top of that as well. So we will start with the whole Black Swan event in terms of the COVID-19, and we will touch briefly later on the oil and gas sector and some of the vertical markets that you're operating in. And then we'll get into the weeds with your own report that was, I believe, delivered earlier this week. So hopefully we can, we'll be able to take a look at that and see any of the information, the updates going on from that perspective. So when it comes to overall the COVID-19 situation, there's quite a bit going on. Actually, myself just got back from Florida yesterday for my first ever traveling gig since COVID-19 for speaking. So I am here quarantined at home for 2 weeks, but we are looking at the overall daily new confirmed cases of COVID-19. It's a 3-day rolling average. So it's looking at the last 3 days, the average trends from the US, China, and several other countries. And we're watching for the second wave. You know, we've made several adjustments to a lot of our forecasts in the past few months, but at this point, we don't have enough juice in the data to warrant an upgrade to at least the markets that you're heavily involved in, which is why you'll see later that we haven't changed the forecast for MTI in general. But what we're seeing here is daily new confirmed cases. The US is at the top there, and I'll use my mouse too to make sure that I can point out where I'm talking to. The US is up there pretty high. It has been recently rising in the past few weeks. Since has been in somewhat of a descent, not enough to warrant that change. Again, we look at more than just cases, because cases can be biased. That is a big thing that we look at. Is the data valid? Is the data good? Can we talk to it? Is it something that we have faith and reliability in? Which is why we look at more than just cases. The more you test, the more positive cases you're going to get. So although we are seeing some spikes here in Spain, we are seeing some flat trends in those other regions. The US in general has since in the past week or so stabilized. It's been generally flat. And a lot of these cases that are coming about are tied to the younger generation, because if you look at the average age of those individuals that are being tested positive for COVID, it's a lot more of the younger generation pulling down that average age, and they're more likely to survive this thing. So what we look at is not only the confirmed cases, we also look at the death rate, we look at the fatality rate and other aspects of technology that's going our way. So when it comes to cases, what we're seeing here is the overall death rate. So we've just looked at cases. Now let's look at overall daily deaths. That's in the red there. The yellow line is the cumulative cases. That's always going to go up. That's the definition of cumulative. It's never you can't go down on a cumulative figure. But what we're seeing is general ascent as of recently, since early July. However, if you compare it to the past, if you compare it to early April, mid-April, it's nowhere near that. And you'll see random spikes here and there. You can see the later parts or the early parts of July, I would say, this one random spike, that was a data anomaly. And there's a lot of data anomalies going on that we've been observing in the data. Actually, myself being in Florida yesterday, talking to a large group of individuals, they were saying that if you work in a certain industry, you have to be tested multiple times for COVID. And if you come back positive twice or 3 times, you're counted as three cases instead of 1. Even though you're one individual, you get counted 3 times. So there are a lot of biases here and there So we like to look at not just one particular metric, we like to look at more than that. So we see that the overall theme here is general descent in the red lines, the daily deaths. It has since ticked up somewhat, which is, we're keeping track of this. I mean, we're looking at it, we're saying, okay, do we need to reevaluate our expectations for our forecast for the economy moving forward? And there's just not enough information there. There's not enough data to warrant that change, because you look at the comparison between the two, between where we are today and where we were the last time we have probably had that discussion a quarter ago for MTI. It's not there yet. If that comes our way, we will make a change. We will make an adjustment, but it's not enough yet. We think we're going to see a good turnaround. And what I like to call it is, I've made this reference before. It's essentially looking at, I like to call it an earthquake, where back to the left here in the early parts of April, the mid parts of April, we saw this heavy earthquake. No one was preparing for it. It really wreaked havoc on the US economy and the world economy. And then we fixed, we recovered since then in May and June, and now it comes the aftershock. But everyone's expecting the aftershock. Everyone knows the aftershock is going to come. They're prepared for it. They're able to kind of weather that storm that's coming their way. And that's what we're looking at now, is that there could potentially be this aftershock, but it's not going to be as aggressive as the initial earthquake. Another metric we track is the fatality rate. Now, this is just looking at Florida. This is not the overall US. The blue line there is overall cases in Florida that we're looking at, and the red line is the deaths. Now, you flash back to early May, the fatality rate was 9.5%. I mean, that's a pretty large number for when we're looking at the numbers here for fatality rates. Today, all the way to the right, we're at 2.5%. Meaning, yes, there may be more cases that we've been seeing in that blue line rising, but relative to the deaths, it's getting much better. And as an economist, I've never expected in my entire life to have to track death rates as an economic metric. I mean, this is something that I've never expected, and it's hard to talk about, but I do have to put my economic cap on and be somewhat unemotional when it comes to the data, because we are looking at deaths. It is very unfortunate, but it does show somewhat of an improvement, where we are seeing that closing of the gap with the fatality rate being 2.5% relative to early May, where it was 9.5%. Now, so regional areas is important, because if you operate on a national scale, certain states are going to perform better than others. That's a given. We look at migration data, we look at population growth data. Certain states are going to outperform others given their certain economic performance. So we have, when it comes to reversing states, when it comes to growth states, when it comes to demographic positions in certain areas, we see a lot of the yellow, the reversing trends in the bottom left and the bottom right. And a lot of the reopening happening in the Midwest, the North region, the Northwest areas. That goes to show, I don't want to make that comparison of completely shut down. So when it says reversing, I would call it more 2 steps forward, 1 step back. It's not 2 steps forward, 2 steps back. It's, yeah, let's not have concerts anymore. Let's not have certain other aspects of the economy shut down. So it's similar to what I was mentioning earlier with the aftershock, is we know it's coming. We know that, we can still go out to eat for dinner. We can still do XYZ things. We just can't go to that concert. We can't hold these large events. It's not the same as the first time around. But from a marketing and a sales perspective, which I'm really hoping to hit home here today, is those bluer states are all reopened. We have a lot of Midwest regions opening, meaning business is good there. that's where the opportunities could be relative to the most, or the more, I would say, mustard color states down in the Southwest, which are reversing. So let's look at the US economic fundamentals. If you've been reading the news and the media since in the past week, you know that last Thursday, or a week ago today, the GDP numbers were published and they weren't great. They were actually pretty atrocious. I do want to caveat that though with the fact that European data came out right after that, and there's very different ways to read the data. Now, there's a lot of metrics reporting this 39.2% contraction in GDP. That's somewhat biased in the way that the data is measured. What we look at is the same quarter from last year in 2019. So second quarter of 2019 is actually down 9.2% this quarter from last year. It's not 39.2%. There's an interesting way that individuals and entities, business entities, measure the data. In this case, it's more 9.2% contraction rather than 39.2% that you've probably been seeing or hearing and reading in the media. Nonetheless, it's still negative. We still somewhat almost dropped off a cliff, and that has to do with a lot of risk averseness. It has a lot to do with a lot of businesses saying, and consumers not being able to go out and spend, which is very different than what we went through in the past 40 years or so, which is what you can see here. This is GDP through time. At the end of the day, economic fundamentals will prevail. We're going to see a decent rebound. However, the top line data is not going to be where it was for quite some time. We're going to see another probably 2 years roughly before we see where we were before this crash held. Meaning, from a business perspective, if you individually want to go out and beat the market and gain market share and do certain things to beat your competitors, you got to focus on certain areas of the economy that are faring better than others. And I'll talk about that too as we get through the slides today. But overall, GDP really took a hard hit in 2Q. I mean, you can see it here. Even 08, 09, the Great Recession, did not fall as severely. However, I will say the silver lining out of this is the fact that a lot of the businesses that the reason for this decline is because of the quarantine. It doesn't mean that demand has disappeared, and I probably talked about this last quarter as well. It doesn't mean that the demand has disappeared for a lot of this, the reason for this decline. Where my mouse is, it's probably because people are just waiting. Businesses are waiting to make the decision, especially heading into an election cycle where we typically see 3Q, the third quarter of the year, kind of slow down in anticipation of what's happening in the overall market and the overall political realm, and then 4Q picks up. And that's very much in line with what we're expecting in the overall economy, is that we're going to see this rebound as we head into later this year in the early parts of 21. But we're currently under review of a new expectation for GDP. We'll let you know once that comes out. But we were already calling for this decline. That's the good news too, is that we were already calling for descent in the overall economy. The indicators were there, and we do expect 2021 to be that recovery year in the overall market. Now, this is the existing forecast that we do have. The dark blue all the way to the left is the historical data. The light teal is our forecast through time. Now, we did expect decline to happen for the next quarter, which I'm circling over right now. It's probably going to fall deeper than that, but the overall theme and the information that I'm spreading is that we're going to see decline followed by rise. It's just not going to match where we were at the peak before. If I drew that straight line across all the way, it's going to take some time. So know that if your business moves with the market, which you do, if your business moves with the overall MTI report, you do move with the market very well. We're not going to see the same levels of top line data, top line sales, top line revenue, top line, whatever you want to track in your own business for quite some time. So in order to beat this expectation, you got to be doing something differently. You got to make changes day in, day out to gain that market share, to focus on certain verticals, which I'll get into as well, as I've already mentioned. So what's telling us that 2021 is going to be a better year? What's informing us of the decision to say, you know what, we're going to be back on our feet again in 2021. We've seen it. I believe that the unemployment claim numbers that were released this morning, to my knowledge, were improving, but also a lot of the leading indicators that were reported here that we track at ITR. And you can see its lead time to the overall industrial economy, which MTI moves superbly well with. I mean, such a great relationship. If you read your report, you'll look at the relationship, the correlation between MTI and B2B activity and industrial activity. The lead time here is showing that, you know what, next year is going to be that better year. We see a lot of rise happening. We see a lot of good things coming our way because of the green. Before COVID, this was all green, which is why we expected us to be in recovery right now. And then COVID hit, a lot of these turned red. And that's what led us to revise our forecast. You know, we're very transparent with you. We'll let you know if you have any concern, if something comes our way in the economy, we need to build it in and integrate it and bake it into our expectations. We'll do that. We're doing that right now with GDP. We're not going to be, you know, completely impervious to what's going on in the rest of the economy. The updates in the market will inform us of what we need to be making decisions on. And in this case, we're seeing a lot of it turn back to green. So at least in our minds, when there's at least 5 of them, that's what really gets us excited about the recovery. And we have clearly more than 5 right here in rise. We have the ITR indicator, we have the PMI, the Purchasing Managers Index, which is a very manufacturing-centric indicator, the Wilshire Market Cap, which is a stock market related indicator. We have capacity utilization, which isn't doing so hot, but it's still doing better than it was, you know, a month or 2 ago. All in that green, which tells us we're going to see the turnaround soon enough, given its lead time on the right there to the overall economy. As I mentioned earlier, we are very transparent. We like to let you know the differences between when we do make revisions to our forecast. Now, even before COVID, we were already expecting a recession to come from the overall industrial economy. That initial forecast is in gold here. Before COVID hit, this is what we were expecting the overall economy to go. Since then, the negativity in the market and the data led us to revise, and this is our new forecast. So these diamonds that you're seeing there is our expectations moving into the future. We had initially expected for a mild recession in the gold there in the near term. Now we're going to be seeing much more negativity. And that's very similar to MTI as well. And you'll see that as we get to that data point. So know that the overall direction is somewhat very similar when it comes to decline this year, recovery next year. But from a top line perspective, whether it be the sales that we track for MTI or even internally from your own business, if it's looking at revenue, if it's looking at other metrics that you track, we're not going to see a whole lot of opportunity unless you're utilizing the webinar today and looking at certain pockets of opportunity that we'll explain. And that's reflected here. So we looked at the growth rate, the growth cycle on the previous page, but what we're seeing here is the top line data. This is overall industrial production from a top line perspective. The teal is our forecast moving forward. Even over the course of the next 3 years, drawing that straight line across, we're not going to see anything top where we were before in 18 and 19. It's even going to be lower than 15 and 16 when the oil and gas market crashed. Be prepared for that. Know that decline's coming. Utilize it to your advantage. If you can start building up your cash reserve now to prepare and weather this economic storm that we're going to go through in the next year, that's great. Utilize that to your advantage. So given the whole circumstance that we're in right now with COVID and the supply chain issues that we've been feeling, you know, I go out on the road a lot. I talk to a lot of clients. I talk to individuals here and there, and they say, we're bringing we're bringing our supply chain back to the US. We can't, you know, we can't get the products or the services we need overseas right now because of everything that's going on. Even politics having its say in the matter. In that case, there is a lot more demand to bring services back to the United States, more nationalistic, more protectionism. And we're seeing that in manufacturers bringing, maybe potentially even considering more vertical integration in their supply chains rather than horizontal. We're seeing a lot more of that going on. Even if it does come at a higher cost, it could splice or could sacrifice a little bit of profitability, but a lot of US manufacturers are saying it's worth it. I can now get the best bang for my buck here in North America or the United States compared to trying to ship it overseas, which I can't right now. And then you got tariffs going on that are really hurting the supply chains from overseas and where we are today. All right, so let's look at some industry drivers. We talked a lot so far about the macro trends in GDP and the industrial economy and the black swan events for COVID-19. Let's look at some particular industry drivers, which unfortunately aren't pointing to the best direction. What we're looking at here is the blue line is raw steel production, the red line is the capacity utilization rate. So we talk about utilization rates, it's essentially looking at how busy manufacturers are in terms of turning around their product or their machines. And at 59.3%, there's going to be no incentive for a manufacturing business to say, let's go expand, let's go invest in new B2B equipment or activity, because we're only operating at 59%. No way that they're going to go invest. So that is going to be a huge hindrance for you and your business to say, okay, there's not going to be any type of expansion or new opportunities going on in the overall industry, at least when we're talking to steel here. So know that where we were in March, I mean, you look at that fall off a cliff there. I mean, that is unfortunate to see. I would say the highway to hell, but 59.3% is telling us, especially you add it, you bake in the lack of profitability going on in this market, there's not going to be any new incentive to go out and purchase. So you got to find pockets of opportunity elsewhere going on. And a lot of that too, when it ties into the commercial market. I know a lot of you operate in the commercial industry. I was actually talking to another economist here at ITR who's very familiar with the overall construction market. And he was saying in terms of construction, there's certain areas of opportunity. Near term, the municipal market will be a good pocket. There's a lot of still order activity going on because it's a very long-term industry to be in. We saw a lot of opportunity last year that's still going on now, but it's not going to last long. So know that in terms of the next month or quarter or two, it will be there, but don't bank on it being there forever. You also look at anything distribution-wise, that's an area of opportunity. Anything warehouse related. An individual I was talking to yesterday, a CEO of a company, a food service company, said, yeah, they're called ghost kitchens in warehouses. So not only looking at construction of warehouses for the e-commerce industry and overall, what I like to call the Amazon effect, we're also seeing warehouses being constructed for what they call ghost kitchens, where they're just making this food in warehouses, and they're delivering it through the Uber Eats app or other type of apps that deliver the food to the door. So there is a big opportunity in the distribution. Also, be cognizant that there is a shift toward the A-tier cities may see opportunities shifting toward the suburbs because of the fear of COVID-19 and the denseness going on in cities. There could be a lot going on there. I talked to individuals from Seattle saying there's a lot of constraints happening in Seattle, not only from the political realm, but the construction realm, where they can't build anything, and they're seeing the outside suburbs really reap the benefits of that. So it ties into, from a sales and a marketing perspective, to just be cognizant that not only looking at the forecast for MTI in general, is that you can move that forecast, move it around from an individual perspective to focus on the areas of opportunity. Retail, brick and mortars, down. Manufacturing plants, down. That's what we're seeing here. Is there's no incentive to go and demand more manufacturing activity. Medical industry, they're up to their necks right now in busyness, and they're not seeing profitability to encourage new order activity. That's going to hurt. So it depends on the industry. Housing right now, probably one of the better industries to look at. Residential housing, warehouse industry, really good. Munis, near term, good. So just jot that down, be aware of it to make sure, from a marketing and a sales perspective, to focus on those pockets of opportunity and away from the negative industries. Quickly touching base here, not a whole lot of conversation to add. I want to make sure we have enough time to talk through your recent report that you saw earlier this week. But the blue line is looking at copper prices. You've probably heard me say this before, but copper has its PhD in economics. It's so widely used in every industry. We also have machinery production in that I would say copper color. So both negative, not going to be boding well. And we'll see that in your industry as well. Now, when it comes to oil and gas extraction, this is just the US, by the way. The top line is looking at the overall business cycle. The bottom chart here is looking at the overall top line data, top line extraction production. A lot going on as of recently. However, the reason for that is because oil prices are so low, it's incentivizing additional production to try to make sure that we can keep up with our profitability, but that also limits profitability. The more supply you give, the higher supply, the less profitability. So this is an industry where, even though we're seeing a lot of production, it's not profitable. It's not profitable at all, and it's going to really hurt in the near term, especially as you have OPEC and Saudi Arabia coming in that can really produce at a lower cost without sacrificing their profits. That's going to, we don't expect a whole lot from oil and gas. So let's talk about you. Let's look at the actual report itself. Now, we did not change the forecast since last quarter. And a big reason for that was because we had not changed our outlook for the B2B side of things, for the business to business, in reference to non-defense capital goods new orders, which is the chart that I'll show shortly. But we do expect a lot of dissent to come from the market over the course of the next year and a half. From MTI, actually I would say MTI sales, not the market trend. And you can see the very numerical figures. So when it comes to 4Q20, the overall average sales figures are going to be over 20% below 2019's level. Now, there could be some up or downsides there to certain individuals that are contributing to the data for this, for MTI. But in general, the average theme, which you move with the market very well, you'll see that in the next slide or two. You move with the market very well. You're not going to see a whole lot of growth for quite some time. The next, you look at the negativity in the annual trend, 1, 2, 3 quarters, 4 quarters, 5 quarters. The next 6 quarters will be contraction year over year. And that, I think this is the biggest part of my conversation today, is to make sure that you're utilizing the economic data to beat this forecast. I want you as a company leader or a business leader to beat the expectation that we have set forth on this page right here and right now. Know that housing's doing really well. Know that the warehouse market's doing really well, and that there's there's a shift from cities, big cities, to suburbs. Focus on those pockets of opportunity to beat this expectation, because I do want you to beat this. But if you move with ceteris paribus, all else being equal in Latin, you move with the market, you're going to not see a whole lot of opportunity in the next year and a half. Even after that, you'll notice the top line data to the left, not going to be far above where you are today from an average perspective from MTI. So please utilize that data, utilize what you can find out in each vertical markets and observe that, gain that market share, do what you have to do, because there's not going to be a whole lot of growth. And if you don't do that, make decisions internally to say, okay, well, we need to cut back costs, we need to do XYZ things to make sure that we're not going to, go under. Quickly looking at the monthly reported data. So instead of looking at the annual trend, what we're seeing here is the overall monthly trend from July 2019 to June 20. If I were to draw a trend line, it would be overall descent. We'd see an overall decline, and that's what we're expecting moving forward as well, given the negativity in the market. So even though June started to pick up, we're still expecting the theme to be general every time. We do not like to look at 1 month of rise, which is what we saw from May to June in the average thousands of dollars of sales, monthly sales data. We don't expect that rise to be consistent because the market's going to be down. We expect you to be down. And that's what we look at here is the overall performance of MTI against the industrial economy. So MTI is in yellow to the right here. Your forecast is the purple, and then the blue line is the industrial economy, which you move perfectly with. So we see that there could be some downside pressure, and the reason for that is we actually have revised our forecast for the industrial economy down since the last quarter, which led us to believe when we were doing the analysis on the overall MTI forecast, we said, should we revise this down because our exogenous economic factors were revised down as well? But your business moves, I would say, well, MTI, the totality of your businesses move better with our other indicator in the report, which is non-defense capital goods new orders. Regardless, keep an eye, track us monthly, not even during these quarterly webinars. Track us during our, follow our blogs. We know that we have revised this downward. It could be a potential downside risk, but at the end of the day, we still ended up revising the industrial forecast, which could be a downside risk. And the reason for that is if you look to the right, historically, we've seen pretty good relationship between the yellow and the blue, MTI and industrial production. We expect industrial production, the blue diamonds there are forecast in the future to kind of have the same amplitude as what we went through in 08-09 to the left. Now, MTI didn't hit that amplitude. MTI was actually more above in the yellow. You can see it troughed out a little bit higher, which is why we didn't want to jump the gun and revise the forecast yet for overall MTI sales, is because we do have MTI troughing out higher than the trough in industrial production. The better indicator that we're looking at is overall non-defense capital goods new orders. This is one on the right-hand side. You can see it's a great correlation. The industrial economy is a great correlation to MTI. This one perhaps maybe a little bit better. And this one we haven't changed, and we do expect a very similar direction to come from the blue and the yellow line, which is why we said, you know what, let's keep the forecast itself. Everything from last quarter is still holding true. Unfortunately, it's not the best news to have is to say you're going to be declining for quite some time. You're not going to see the levels that you've seen in the past, but at least you know it's there. At least you know it's happening. It's better to know bad news than to ignore it and to be oblivious to it. You know it's going to be negative. As I mentioned, focus on those vertical markets. So in summary, and I wish I had more time to talk to the Great Depression, for many of you that are probably on the phone right now or on the line have heard Brian and Alan Bolio, our CEO and president, talk about the 2030 depression and whether or not we actually get a lot of questions saying, is that happening right now? Has it been pulled in because of what's going on? The answer is no. So I'll quickly talk base just for the next minute or so. I don't have slides on it, but I want to make sure I talk to it. No, the reason for this recession that we're in right now is completely independent of economic factors. This was this black swan event, this pandemic that we could not control. The factors that are contributing to the 2030 depression are still there. It's even more actually right now because of the inflationary environment we're going to go through with the stimulus package, the trillions of dollars of stimulus that we're pushing into the economy. We're adding on all of that, and 2030, the drivers are demographic trends. They're social security, entitlement trends. It's all of those economic factors that haven't disappeared. It hasn't been pulled into today. It's still going to happen in 2030. So we are still firmly adamant on the 2030 depression, and that we're going to go through this apocalyptic downturn, unfortunately, but it has not been brought into today. This is just another recession that we're going through, and we'll still see that downturn. So know that in terms of 2020, we're in this black swan driven recession. Next year, we're going to see that recovery trend, but know that recovery does not mean growth. Recovery just means we're getting back on our feet. We're going to see that. You've seen it from your report. The top line levels are not going to match where you probably have been in 2018 and 2019. Know that. Utilize this report. You'll get the PDF of this. You'll get the PowerPoint to focus on, to say, where do I need to be focusing certain eggs into certain baskets? 2022, we're going to be on the backside of the business cycle again. That's just this. That's how cycles work. Every business, every market, every economy goes through periods of rise, periods of decline. So after we head out into this recovery trend in 21, we're going to be back on the backside, or on the farther end of the business cycle in 22. Do not compare it to today, though. We're not going to see that type of decline as we move into 22, 23. It's going to be much more mild. So there's a lot of factors at play that contribute to this expectation of recovery. There could be some risks. Now, us at ITR, we forecast the economy, we forecast markets, we forecast companies. Unfortunately, we cannot forecast governors' minds. I don't know what a lot of these governors in certain states are thinking. I wish I could, but it depends on whether or not they do additional shutdowns that could potentially threaten the recovery trend that we're expecting in 21. Now, I'm not a big fan of reading verbatim, so I'm not going to walk through all of this, but we are seeing some optimistic trends in a lot of these indicators. We see the housing market in that rise. You saw the earlier chart that showed a lot of that green in rise, which is really encouraging news. So make sure you capitalize on it. These are some management objectives to take away. Know which regions of the US are doing better than others in terms of opening up sooner or later. Are you cash heavy right now? Are you able to control your accounts receivable? Did it go from a 30-day to a 90-day to 120-day turnaround? Make sure you be more aggressive on that, especially as we head more into the decline in the near term. So really focus on the time that you probably have now in your business, given the lack of top line data that we expect from the economy. Focus that on timing your positioning of the recovery, knowing that you will head up in 22. What can you be doing now? Can you be shedding some of the fat of the individuals, those C players? Can you be training the A and B players to focus on, while they have the time right now in the business? If you're not as busy, this is when you want to start training up. This is when you want to start making sure that they're able to really, really reap the benefits of growth again once it comes our way. It's not going to be tomorrow, but it will come. Alrighty, so I will open up the floor to questions now. I don't see any questions that had come in for the last 45 minutes, but I'm happy to hang on for a few minutes if you want to chime in at all, either verbally if you want to unmute yourselves, or also through the chat form. I'll stick around. And if not, if I don't see any, I believe Tom Morrison has my, he has my email, so feel free to email him and he'll forward them along to me. Again, huge shout out to Tom for putting this together. He always comes in very well every quarter to coordinate this, and I always appreciate that. So I'll give it another minute or so, but I'll hang around and hopefully I can answer any questions you have. All right, so I just got a question saying, what were the verticals you see positivity in? So there's multiple different verticals with positivity, not a handful, unfortunately, with the time that we're in right now. So the good verticals are residential housing. Housing is doing extremely well. You give the low interest rate environment that's happening right now. That's really encouraging individuals to go out and buy a house, especially with the stimulus act that didn't really wreak havoc on a lot of the savings and checking accounts of individuals, that added on to that incentive. So housing, we have distribution and warehouse doing really well with the e-commerce effect, and a lot of the lack of contact that we've been seeing lately because of COVID has driven a lot of businesses to the warehouse industry. They don't need to have the pretty shop or the brick and mortar. They need to just churn out product in a warehouse. So that's a good industry to be in. In terms of the negative side, well, I mean, I guess I talked about the positive, but the negative side of things, education, construction, there's, a lot of individuals saying, yeah, no, there's no demand there. We're not, Harvard's offering no change in their tuition, but you need to do everything online for the first year. That's insane. That people are still going to pay that. So we're not going to see a whole lot of investment toward education. Medical industry down. There's no profits there. Brick and mortar retail in general is down. Manufacturing's down. But the positive opportunities is housing, warehouse, distribution, and near-term municipal. The next question I have is, how will the additional government debt impact manufacturing? Is this baked into your forecast? So I think that those two are somewhat independent of each other when it comes to additional government debt in the overall manufacturing industry. I think that in general, this downturn that we're in right now, definitely going to impact manufacturing, where we saw a decade ago, 10 years ago, when we look at data and relationships between markets and businesses, there was a huge shift 10 years ago where businesses after the Great Recession were much slower to react on investment activity compared to before. The second you start to see activity rise in the near term, before the Great Recession, businesses said, yep, let's go invest. Let's go get new equipment. Let's go hire new people. After the Great Recession, even if they start to see that rise, they were saying, you know what, I don't want to pull the trigger too early. But in terms of government debt, I would say that is just an additional catalyst to 2030 in the depression that we're going to see. I don't see a huge tie to manufacturing. What I see is those two are somewhat mutually exclusive from one another, but manufacturing could potentially benefit in the US in general because of the nationalistic approach and the protectionism that we're seeing nowadays, as well as the more risk-averse trends that we're observing because of COVID-19 and the struggles that a lot of US businesses are facing trying to get product from outside of the US. All right. Well, I thank you everyone for your time today. I really appreciate it. I'm glad I could get on the phone and talk to everyone. Again, feel free to reach out to Tom Morrison or myself as well if you have my contact information with any additional questions. A copy of this presentation will be sent to Tom, who will distribute to everyone, as well as a PDF of the slides that were shown today. So I hope you guys have, or everyone has a great rest of their week and a great weekend, and hopefully we can talk next quarter. All right, everyone, take care.